My name is Jake, welcome to the channel. In today's video, we're gonna take a deep dive into my portfolio. I'm gonna share with everybody what I'm investing in, why I invest in the stocks that I invest in, why I break up the allocation, the target allocation, the way that I do, how I have the transfer set up, everything from start to finish when it comes to my dividend growth portfolio here that I share on YouTube here in M1 Finance. If you've been following my channel, my wife and I, we're down here in Austin, Texas, and we invest for cash flow. We're looking to retire off of our dividend growth portfolio in the next 8 to 10 years. We're currently in our mid-30s and we're looking to retire in our early 40s. If you watch anything about personal finance or investing here on YouTube, you probably have heard of the concept passive income. Passive income is something that a lot of people are striving for. A lot of people think that passive income grows on trees, but in reality, it's not that simple. I absolutely love dividend investing for passive income. I also own real estate here in Austin, Texas. I am a do-it-yourself landlord. I love investing into real estate, but it's nowhere near as passive as dividend investing. For example, just yesterday, I had to replace a kitchen faucet in one of my rentals. And as a do-it-yourself landlord, this falls on me. Yeah, sure, I could outsource it. I could have a contractor do it. I could have a property manager do it, but then my margins would be thinner. So I've decided to do it all myself. By doing it myself, I have a higher return on my investment. I was so excited yesterday that I was able to change the kitchen faucet. I'd never done it before. I've always, either rented in the past when I was living in Germany, or I've just never had to do it myself. And I was so proud that I did it myself. I watched a few YouTube videos. I got the parts at Home Depot and did it, and it only took about an hour. And I texted my realtor afterwards, a guy that I work with here in Austin, and I was like, hey man, I changed the kitchen faucet. I'm so excited. It was so cool. And he's like, yeah, that's awesome, man. Did you know that your home warranty covers that? And I was like, wait, what? My home warranty covers that? Yeah, you just pay 70 bucks and your home warranty will take care of it for you. And I was like, well, shit, I just paid a little over 100 bucks for everything and did it myself and spent the morning doing it. And then it kind of made me feel like this afterwards. Well, I guess you live and you learn. I've been dollar cost averaging into my M1 Finance portfolio for a little over a year and a half now. I transferred over from Robinhood into my M1 portfolio. And when I first set up my M1 portfolio, the account, I initially set it up. I was a little bit skeptical because at the time I was using TD Ameritrade, and I was under the perception that, these newer internet brokerages or robo-advisors, that they were a little bit risky. And so I was a little bit skeptical when I first transferred over or set up the account. I started with like $100 or $1,000. And then after using it and learning more about it, I then transferred over my Robinhood account into M1 Finance. And I've been dollar cost averaging into the portfolio ever since. So I've been, on a weekly basis, in some cases almost daily, transferring over a small amount every single day. So I have a 9-to-5 job. I work as a sales manager. I get paid on a bi-weekly basis. I also am paid on commission. So at the end of each month, based off of the sales from my team that I work with, I'm able to invest into the portfolio. So my portfolio is fully funded from my 9-to-5 job and from the rental income that I have coming in. So I've been dollar cost averaging into the portfolio, and as you can see, it's been pretty consistent. It's gone up and up and up to the right. And then here in about March, April, the portfolio started going down. I was then doubling down. I was investing more every single week. I was taking advantage of the dip. I was buying more and more, in my opinion, at a discount. And so since then, I've been dollar cost averaging into the portfolio ever since, and it's been going up and up and up. Now, this approach is a slow and steady approach to wealth. I could invest everything in a Tesla and I could double my money in a year. I'm fully aware of that. And for me, that's not my investing approach. I invest for cash flow. I'm not investing for capital appreciation. Yeah, sure, when the stock price goes up, that's great. It gives me the warm fuzzies inside. But in reality, what I'm focusing on the earned dividend. I want the dividends to grow every single month. On a monthly, quarterly, and annual basis, I want my dividend income to grow, right? And so in terms of a total return, yeah, the capital appreciation is important, but that's not my investing approach. I invest for cash flow, for passive income. And when I see the stock market go up, right, where we're hitting all-time highs, I don't get so excited about that because my yield on cost, the amount that I'm getting in the yield, the dividend per share price is dramatically lower when the share price goes up. So for me, I actually would prefer the stock market to go down so that I can buy into wonderful businesses at a valued price or a discounted price. So regardless if the stock market is up or down, I am always buying into the market. I am always dollar cost averaging into my portfolio. I have two portfolios here in M1 Finance. I have my real estate portfolio and I have my cash flow portfolio. I also leave a link to this portfolio. I don't talk a lot about it here on the channel. I will, in the future, talk a little bit more about it. But if you want to check out that pie, you can do so. The link is in the description below. But I focus mostly on my cash flow portfolio, and I'm transferring about $1,000 a week into my cash flow portfolio. And once again, the dollars here, the amount that I'm transferring, it's from not my 9-to-5 job. It's from blood, sweat, and tears working my 9-to-5, right? And so this is how I have the portfolio set up. And now $250 a day or $1,000 a week is a lot of money to me, right? And I haven't been able to do this forever, but it's been important for me to cut my costs, get out of consumer debt, and make more money so that I can invest more into my portfolios. So when you look at the activities here in the portfolio, you can see that the dividends are piling in, right? The dividends from the portfolio are coming in every single month. And the way that I have my investments set up, the majority of the dividends are paid in, September, December, March, and June, those months for the most part. But I do have some others paying in different parts of the year. It is so exciting to see the dividends come in and that they're growing. They're growing every single quarter as I'm investing into them, adding more capital to them, and as they're growing organically within the organization and they're increasing their dividends paid out to shareholders. And the thing that I love about M1 Finance is it's different from a traditional DRIP. If you have in a traditional brokerage like Schwab or Fidelity or Vanguard, for example, and if you have the traditional DRIP, the dividend reinvestment plan set up, and say, for example, you have Coca-Cola or Visa, just as an example, the traditional way to reinvest dividends is that it gets reinvested directly back into the same individual company that generated the dividend. With M1 Finance, it's different, right? So the way that it works is the dividends get paid out to the account. I have my account set up to auto invest, and what M1 Finance does, it leverages the dividends that, say, for example, Visa or Coca-Cola paid, and then invests into my underweight holdings, the other holdings into my portfolio. It's setting up pretty much an automatic rebalance, and I don't have to trigger a taxable event with that. So I absolutely love that. For example, on December 1st, I got paid a dividend from Pfizer, WTRG, Visa, and SJM, for example. They hit the account on December 1st, and then they were reinvested into the portfolio on December 2nd. On December 2nd, I actually added a one-time transfer of $1,000. And so instead of just investing $1,000, the portfolio invested $1,000 plus the additional $17 in dividends that were paid to the account. And from that, M1 Finance automatically invested into my portfolio, into the holdings in my portfolio that were underweight, right? And so this is how M1 Finance leverages the auto invest and auto rebalances your portfolio. When looking at Pfizer here, ticker symbol PFE, if you were a shareholder of Pfizer, you just recently got a new holding in your portfolio, ticker symbol VTRS. And if you didn't know that they spun off part of their business, it may have come as a shock to you. And for me, it was kind of a shock. I looked one day and then all of a sudden there was a new holding in my portfolio, and it made me kind of feel like this.
What are you doing?
What are you doing?
I have 50 holdings in my portfolio. 5 of the 50 are dividend ETFs and 45 are individual companies. Here in 2020, my portfolio has fluctuated. It's gone up and down. The majority of the holdings are now in the green, and the largest holdings that I have in my portfolio are my 3 dividend growth ETFs in SCHD, VYM, and DGRO. And if we look at the holdings that are in the green, the highest performing holding that I have in my portfolio is Apple. And when looking at the lowest performing this year in my portfolio is Altria Group, Dominion Energy, Consolidated Edison, and Kimberly-Clark and McDonald's. Now, you could say, okay, well, are these good buying opportunities for these companies? And in my opinion, I think Kimberly-Clark is a great buy. I think seeing that Kimberly-Clark is currently being sold off, I think this is personally a buying opportunity to increase your yield on cost. And the same is with McDonald's, right? I would much rather buy Altria Group, Kimberly-Clark at these prices than I would buy Apple, UPS, or AbbVie. Though I love Apple, UPS, and AbbVie, I think from a value perspective, I think the companies that are down for the year or have not, jumped up in price and valuation are a much better buy for dividend growth investors. Now let's take a look at the individual slices that I have in my portfolio. The way that I have it set up, I have 50% of my portfolio here in M1 Finance allocated to 3 dividend growth ETFs. And we're going to take a look at each individual slice in here in a second. I have 12% allocated to industrials and consumer staples. I have 8% allocated to utilities, 7% to healthcare. I have 2% allocated to technology. With my time horizon of 10 years, I'm looking to live off of the cash flow from my portfolio and not liquidate my shares. In order to do that, I need to skew more towards current income. Now, sure, if I had 30 or 40 years ahead of me before I wanted to live off of the dividends, yeah, technology would make a much larger percentage of my overall portfolio. So make sure that you understand that. And I've shared a lot of videos on this in the past. When it comes to dividend investing, your time horizon really dictates how you should set up your allocation in your portfolio. And I've shared a video on that on different time horizons and different individual holdings that you could consider based off of your time horizon. So for me, with a 10-year time horizon, I'm not looking for the growth, I'm looking for the current income, or more skewed towards current income, because I actually want to live off of the portfolio and not sell my shares to fund my living expenses. Very, very important. I also have 2% allocated to materials, 3% allocated to telecom, 3% allocated to consumer discretionary, and 1% to financials. Let's take a look at the first slice here, the dividend growth ETFs. In this slice, I have 3 ETFs. I have SCHD, VYM, and DGRO. SCHD and VYM make the largest holdings in this slice. SCHD and VYM are more skewed towards current income or a higher dividend. And they're very different in their approach. SCHD and VYM have a very different approach to the type of holdings that they have in their fund. For example, SCHD has 70 holdings, whereas VYM has over 400 holdings. So they're fundamentally different, though they're both skewed or focused on a higher current dividend. I like having DGRO in the portfolio because it also adds a little bit more growth to the overall portfolio. So with SCHD and VYM, they're not growing as quickly as DGRO, but they have a higher current yield. By having all of them in the portfolio, I believe it adds a good mix to the overall portfolio. And also with DGRO, DGRO has a lot more exposure to technology, so I am actually getting technology exposure more so through DGRO. Now let's take a look at the industrial slice here. The industrial slice makes up 12% of the overall portfolio. I currently have 3M at the highest position or the highest allocation at 25%. The second is waste management. I absolutely love waste management. If I had a longer time horizon, I would bump up waste management to the highest allocation in this slice. But given my time horizon of 10 years, it wouldn't be wise of me to do that. I also have Caterpillar, General Dynamics, Honeywell, Lockheed Martin, UPS, Raytheon, Emerson Electric, Union Pacific, Dover, Republic Services, and A.O. Smith. These are the industrials that I have in my portfolio. Now, the thing with the industrials have a great track record of dividend growth. However, when looking towards the future, a lot of investors are counting industrials out because they're so focused on growth. They've seen what's happened here in 2020, where you have some companies up 50%, 100%, 300%. Like, it's absolutely incredible. That's why diversification is so important. I really like the industrial sector really for the consistency. You can see that these companies have a great track record of dividend growth. And when it comes to retiring early and living off of your dividend, you don't want to see that big fluctuation, where they're increasing the dividend one year and then decreasing it another year, and kind of like a roller coaster. With industrials, it's really, in my opinion, from a dividend growth perspective, it's kind of a smoother ride where you're not having those big swings in either direction. You're having a steady 8-9% increase in dividend growth year over year. And you're not getting those swings onto the upside or to the downside like you would with other sectors or other industries in the market. So when we look at the next slice here, consumer staples are very similar for me like industrials. Consumer staples, they're kind of like that steady eddy, right? You're not going to have massive swings in either direction. They're growing fairly consistent on a year-over-year basis. They're not really necessarily in double-digit growth like you would with technology companies, but they're more consistent. They're growing 7-8% year over year. 2020 is an off year. It's kind of a weird time. I'm hoping in 2021, 22, 23, we're going to still see trends towards more skewed towards growth, but I think you're going to see more of these cyclical or consumer cyclical companies performing better. The holdings that I have in the highest position in this slice are Coca-Cola, PepsiCo, Procter & Gamble, and Kimberly-Clark. I really, really like these stable brands, these stable names that everybody has heard of. And another thing that I like about Coca-Cola, Pepsi, Procter & Gamble, and Kimberly-Clark is they all pay a dividend on a different schedule. I also have Altria Group, J.M. Schmucker, Walmart, Costco, and Kellogg. Now, when you compare Kellogg with Costco, they are night and day. They're very, very different. Costco is a true growth play, whereas Kellogg is a traditional consumer staple. It's growing nowhere near as quick as Costco, but it has a nice, healthy, stable, high dividend. Another reason I really like investing into consumer staples is they're up in your face as a consumer. When you go to the store, when you go to Walmart, Target, Costco, whatever, you see these products all over. You see them right in your face and you understand them, right? You might have products of PepsiCo or Coca-Cola or Procter & Gamble here in your home, for example. And it's a little bit easier as a consumer to understand these businesses. Now let's take a look at the utility slice here. The utility slice makes up 8% of the overall portfolio. In this slice, we have Southern Company and Duke allocated at 25%. This is because these are higher current yielding utilities. Also, we have Consolidated Edison at 20%. We have NextEra Energy at 10%, Dominion at 10%, and Essential Utilities at 10%. When you look at these utilities, they serve their own purpose. With Southern Company and Duke and Consolidated Edison, this is more for current income. These are higher yielding individual utilities. Whereas, for example, with NextEra Energy and Essential Utilities, these utilities are growing faster but have a lower starting yield. And so having that mixture here in the portfolio, that's what I'm looking for. I'm not looking for just a pure current income play, but I'm also balancing out the overall portfolio with a good balance of growth as well. The next slice here is going to be healthcare at 7%. In healthcare, we have 5 holdings with Johnson & Johnson allocated at 50%, AbbVie and Pfizer at 15% apiece, and Stryker and Medtronic at 10% apiece. Now, very similar to the utility slice, Johnson & Johnson, AbbVie, and Pfizer have a little bit of a higher starting yield, more so mostly with AbbVie and Pfizer than, for example, Stryker or Medtronic. And now also, like with the utility slice, this is to find a balance between growth and current income for the overall portfolio. But once again, more skewed towards current income for the most part. Now let's take a look at the technology slice at 2%. For those of you that have been following the channel, you know that I work in the technology sector. And for me, technology, there's always disruption. There's always innovation happening. And for me, looking 10, 20, 30 years into the future, I never intend on selling my core holdings. It's difficult for me to predict or look into the future and forecast who's gonna be the winner. There are, for me, a few clear winners in the technology space, But for me, I've focused more on, you know what? I'm not going to try to pick all of the winners. I'm going to focus more on an investment that's going to answer that question for me. And by doing so, I've selected the Vanguard VGT, the technology sector ETF, and that's the largest holding that I have in this slice at 85%. I also believe that Apple, Microsoft, and Visa are going to continue to be around, and I feel very comfortable investing into them for the long term. But as I mentioned before, I've decided to focus more on a sector-specific ETF for the technology sector, and that has to do with my own personal opinion, right? Because I work in the technology sector, because I've seen how innovation and disruption takes place every single day. For me, I would much rather, and because I'm planning, 10 years, 20 years, generations into the future, I really feel more comfortable having a industry-specific ETF in the technology sector in my portfolio. And that might be the case for you, and it might not be the case for you. But for me, that's the reason behind why I've set up the portfolio the way that I have. When looking at materials make up 2% of the overall portfolio. I have it evenly split up into 4 holdings, and I have it in Sonoco Products, PPG, International Paper, and Air Products and Chemicals. The materials sector is a little bit more difficult for your average person to evaluate and to invest in, especially in the individual companies. The reason why is a lot of these companies are B2B. Not everybody goes and purchases products, as a consumer from Air Products and Chemicals. Not always, right? It's a little bit more difficult because they're not up in your face. Like when you go to Target or you go to Walmart or wherever, you're not going to see these products necessarily on the shelf. Now, if you go to Home Depot and you're a painter and you need to paint your room or whatever, then you would see products from PPG, for example. But in most cases, most consumers are not going to necessarily be able to buy products from Sonoco or International Paper because these are B2B focused companies. And because of that, because these are not consumer facing companies, a lot of people don't talk about these type of companies, but I think they are great dividend growth companies. And that's why I have them in the portfolio. Let's take a look at Telecom. Telecom is set at 3%. In my Telecom slice here, I keep it pretty simple. I have 2 slices. I have AT&T and I have Verizon. In my opinion, AT&T and Verizon are great dividend companies. Now let's take a look at the consumer discretionary slice that makes up 3% of the overall portfolio. In the consumer discretionary, we have Disney, McDonald's, and Target. Now, I firmly believe in McDonald's. I firmly believe in Target as pure dividend growth plays. However, with Disney, I am going to keep Disney in the portfolio. I think Disney, from my time horizon, it doesn't make sense to have Disney at the highest allocation. I was very, very bullish with Disney before the pandemic. And because I don't have a crystal ball, I could have never foreseen this happening. However, I'm still going to hold Disney in the portfolio, but long term, I'm not going to be adding to Disney as much as I would be adding to McDonald's and Target, for example. But I still believe that Disney deserves a spot in the portfolio. It's a great, great company. And you've probably, if you've watched the video this far, if you've watched the entire video, you probably have seen a trend in my portfolio. I keep a balance or a mix of current income and growth. And Disney, for me, is a growth prospect, and I'm looking generations down the road. And that's why I hold Disney in my portfolio. Now let's take a look at the final slice here in financials. Financials are very similar for me like the technology sector. There's winners and losers. There's disruption, there's scandals. In some cases, there's things that you really can't foresee as an investor. And for me, instead of trying to pick the winner, there are a few clear winners today. Whether that's the case in 10 years, 20 years, who knows? The goal for this portfolio, for this slice, is I want to keep it as passive as possible. I'm not looking to think, okay, well, interest rates are going up or going down. I don't know what I'm going to do. Am I going to have to sell out of X company or Y company? For me, I've decided, because it makes up such a small percentage of the overall portfolio anyways, I've decided to just stick with a sector-specific ETF, VFH from Vanguard. The goal of this portfolio is so that we can live 100% off of the dividend cash flow from this portfolio in early retirement. In 8 to 10 years, we're looking to amass a $2 million portfolio with an average dividend yield of around 3 to 3.5%. Our goal is to generate between $70,000 and $75,000 in annual cash flow. No one knows what the future is going to hold. The market could go up, the market could go down, dividend yields could go up and down, but it's kind of like a moving target. That is our goal. My wife and I, we track the progress of our dividend growth portfolio every single month. It is so exciting to see the dividends come in every single month and seeing them grow quarter over quarter. We track our dividend cash flow from this portfolio in Propeller.com. Propeller is from Dividend.com. It's currently in beta, so it's not open access to everyone. You can register and get on a waiting list to get access to Propeller. I've been using Propeller for about a year now, and it's been great. There are times when the dividend yields are not absolutely accurate or correct, but for the most part, it's a really, really cool program to track your dividends. And so this is a way that we track the income from our dividend portfolio. And we can see here, okay, what are the projected dividends that we're going to be getting on a monthly and quarterly basis? For example, for December, we're looking to rack in over $600 in dividend income. One of the things that I love so much about dividend investing is it is truly passive. As we continue to add capital to the portfolio on a weekly basis, and seeing the dividends grow quarter over quarter, they're also growing passively from the individual companies. These companies that we're investing in, they're growing their dividends year over year, 7, 8, 10%. I don't know a lot of people out there that get a 10% pay raise at their 9-to-5 job. With dividend investing, it is absolutely possible. You're able to get that organic growth from the portfolio, from the investments in the portfolio. One of the things that my wife and I love about dividend investing is tracking the progress. We see the dividends increase every single month, every single quarter. It's something that we do as a couple. At the beginning of every single month, we review what was the dividend cash flow that we got from the previous month. It really makes this whole process a reality. You can see the cash flow growing every single month, every single quarter, and it is a great thing to do with your partner. If you are married or you're in a relationship and you have a similar goal to retire early off of your dividend portfolio, it is such a cool thing to do if you're in a relationship and you share that same goal with your partner. It does take a lot of commitment. It is a slow approach to wealth. It's not a get rich fast approach to wealth. It is so cool. Every single month, my wife asks me, how many dividends did we get last month, right? And we look at this together and we're on this journey together, and it is so exciting. Thank you so much, everybody, for watching the video and supporting the channel. I don't sell a course. I don't sell anything here on the channel. Everything that I do, I provide the content 100% free. I don't have a Patreon page. I do everything for free. If you do want to support the channel and you want to pick up some cool merch, there is a link to a dividend merch shop in the description below. That's one way that you can support the channel. Thank you so much, everybody, that have already supported the channel and purchased dividend merch. I am fully committed to keeping all of my content 100% free to access for all of you. I do run ads on the videos. I do offer the dividend merch, but beyond that, everything that I do here on YouTube is for free. Thank you so much for those of you that do want to support the channel and pick up some merch. There's a link in the description below. If you like today's video, give me a thumbs up, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.